Hi, this is Tim Hilterman, a certified financial planner with Whitcomb Hess, CPAs and financial advisors. On this video, we want to boil down what's been happening in the market and what you should be doing in light of all these recent events. I have Ryan Gilmer here, our Chief Investment Officer. And Ryan, what's been going on? The market has crashed for all intents and purposes. Can you describe what we're going through in the market?
Yeah, I think that's a good way to put it. I think, we feel like looking at this kind of crisis in three phases might be helpful for investors. And the first phase is the one you bring up, kind of the initial panic or the initial crash, which has really happened over the past five or 6 weeks, about mid-February, as a lot of the coronavirus news came out. And initially, I think investors were just grappling over, how serious the virus was. There was a period of time in which, a lot of people were, downplaying the seriousness of it and the economic fallout of it. But during that kind of 5 or 6 week period, the market fell, the S&P 500 fell about 35%. And we were seeing very, very elevated levels of volatility, consistent with October or November of 2008, which is kind of the depth of the financial crisis. Big intraday swings in the market of 8, 9, 10% or more. If the market falls by 7.5% during the day, it's what's called a circuit breaker, where they stop trading for 15 minutes. And we saw all of those things happen during that 5 or 6 week period. On the 23rd of March, the market kind of reached an intermediate bottom so far, and we've had a pretty significant rally off of that point. And so hopefully, we feel like the initial panic phase is kind of passing us. People understand kind of what the virus is, understand the impacts in general, understand the seriousness of it. And so hopefully we're kind of completing phase one.
Okay, so I guess you referenced 2008, we're in a bear market now. And can you compare this bear market, which is a 20% drop in stocks, to other bear markets in the past? Is this one of the worst bear markets? Where are we at in regards to that?
That's a good question. Our research has indicated that there's a range. There's a range in terms of how far the market falls before it starts going back up. And there's also a range in terms of time frame. How many months or years does it take for the market to bottom before it starts turning around? And really, since 1950, the shortest in terms of time frame was bear market was 1987, which took about 3 months from the peak to the trough. And then the market actually turned around pretty quickly and ended up finishing positive that year. The financial crisis in 08-09 was actually about 18 months from the top to the very bottom of the market. The range of price difference ranges anywhere from 20 to 25% on the more mild cases, to the financial crisis, which was 55% down. So the current decline of roughly 35% from the top to the bottom it's the quickest it's ever happened, but it's kind of smack dab in the middle of that range in terms of price decline. So it's definitely worse than some of the more mild bear markets we've had, but it's not quite to the depths of the financial crisis at this point.
And so if panic is that first step, obviously, I think we've all felt that emotionally. Our account values have dropped significantly very quickly, as you had mentioned. What's the next phase in that, and what should we be looking for?
Yeah, I think now the next kind of phase two, as we see it, is kind of the economic fallout phase. We're kind of trying to figure out, the market's trying to figure out how long will the economic fallout last? How long will we be in kind of this quarantine, work from home scenario? How many businesses are going to not be able to survive this period? Will that be measured in terms of weeks? Will that be measured in terms of months? And I think a lot of, obviously the information we're getting from the health professionals and medical people are indicating that, around this area, we're going to see some increases in case growth over the next couple of weeks. And then eventually, people are predicting that cases may peak in mid to late April. And then we'll have to kind of see how long this lasts. And so just because we're beyond the initial panic phase doesn't mean that volatility is going to go away and the market's going to rebound right off of its lows. I think we could definitely continue to see volatility, although not as much as we saw in the panic phase. And while we figure out how long is the economy going to be effectively shut down, and how long is it going to take, and what's the rebound going to look like on the other side of that. And I think that phase is going to be measured in the next few weeks to months while we get more detail on how this virus is spreading and when we'll start to be able to, get back to more normal state. We have seen a lot of positive developments. We've seen a lot of increase in testing. Abbott Labs just came out with a test that can give a result in under 15 minutes. As we start to get more testing availability, it'll help the quarantine measures, make us more efficient in how we quarantine people who are positive as opposed to everybody. So that's all going to be happening over the next weeks and months, and the markets will be reacting strongly to a lot of the positive and negative news over that period.
And then what's that last stage as far as rebound? What are we expecting to see there, and what should we be doing now to prepare for that?
Yeah, I think we're really counseling clients. I mean, like we said before, phase 3 we consider to be the economic recovery, and historically all bear markets have ended in recovery, and the market goes on to make new highs. And so when we look at historically how the market has gone down already, it's already a very significant bear market. So if we go back down to the lows of where we were on the S&P 500, as of March 23rd, we really feel like our clients and investors in general should start to think about, positioning their portfolios for the recovery. It's going to be very tempting for people as they continue to see bad news to want to panic or to want to sell their stocks or riskier based investments and get safer. But really the best way for you to improve your long-term results is to really use this time to at least hold to the asset allocation you have now, or look to add cash or increase your stock percentage or get more aggressive during this time with an eye towards the longer term recovery. So we've seen what we've seen already has been very significant from historical standards. We could still yet see some more market downturn. We could see some more negative returns in this phase 2 period, but eventually, I think investors will be best served by keeping their horizon out a year or two, where for the most part, there's a high probability we'll get a vaccine. There's a high probability that we'll be able to get past this situation and move forward. So that's really, I think, the value we're trying to add to clients right now is to think about where they'll be over the coming years and really look for opportunities to keep them investing and to kind of keep a long-term focus.
Yeah, I think basically what you've mentioned is keeping the long time perspective is very important during this time, and that's what we're trying to do at Whitcomb Hess here with our clients, help them keep an eye on the future, understand that there are opportunities to take advantage of right now. So thanks, Ryan, for joining us. I'm going to share an important disclaimer here to wrap up our video. So thank you for joining us. If there's something that we can help you with, please put a comment in the comments and let us know if you have any questions. Thanks for joining us today.